Welcome to the Explainer. Okay, let's jump right into this. Today, we're exploring the fascinating and honestly super high-stakes world of technical analysis and trading psychology. We're going to unpack a tool that literally millions of traders use every single day to try and predict the stock market. And more importantly, we're going to look at the hard data to see if it actually works or if it's just leading people straight into a financial trap.
Listen to this staggering statistic sourced directly from IG International. 71% of retail client accounts lose money when trading CFDs. Just let that sink in for a second. The vast majority of everyday people trying to outsmart the market end up losing their capital. The financial stakes in trading are incredibly real, which begs the question, what tools are people actually relying on to make these risky decisions? So here is the million-dollar question. Are you really trusting your hard-earned portfolio to a single, simple shape on a screen? In this explainer, we're diving into the intense allure of visual trading patterns and stacking them up against the incredibly complex reality of the market. It's the ultimate showdown, right? Human intuition versus cold, hard mathematics.
All right, let's start with Section 1, the appeal of candlesticks. These charts aren't exactly a modern invention. They actually trace all the way back to 18th century Japanese rice markets, formalized by a guy named Munehisa Homa to track supply and demand. And their anatomy brilliantly illustrates why they're still an absolute staple of trading today. A candlestick takes all the chaotic, messy price action of a trading session and synthesizes it into a neat little box. The opening and closing prices form that thick middle part, the real body. If it closes higher than it opened, boom, it's a bullish winning session. If it closes lower, it's bearish. And those thin lines stretching out above and below, those are the shadows, or wicks, showing the absolute high and low prices reached during that time. It's just a really elegant, immediate visual summary.
Moving right along to Section 2, Anatomy of a Shooting Star. When you check out a lineup of classic patterns, the shooting star really grabs your attention. Notice how it has that tiny little body sitting right at the bottom and this massive, long shadow stretching way up. It literally looks like a star falling out of the sky with a tail trailing behind it.
Now in trading, precision is absolutely everything. So let's define this strictly. A true shooting star is a bearish reversal candlestick. It's got a small body, meaning the open and close prices were super close to each other, but the critical feature is that long upper wick. It has to take up at least half the entire length of the candlestick to count. And finally, it should have a tiny or totally non-existent lower wick.
But hey, placement is everything here. A true shooting star really only matters when it pops up right at the absolute peak of an established uptrend. Prices have been climbing, and then, boom, this shape appears. To visual traders, this is a massive flashing warning sign signaling a potential market top.
The behavioral story behind this shape, it's fascinating. That incredibly long upper wick basically represents a fierce battlefield. The market opened, and the bulls, the buyers, confidently pushed prices up to new, soaring highs. But suddenly they hit a brick wall. They met massive, overwhelming selling pressure from the bears, who forced the price all the way back down to exactly where it started. The shape physically represents a failed rally and a sudden, violent shift in momentum. Which brings us to Section 3, Dangers of Single Signals. Okay, let's pivot from the theoretical promise to the cold, hard statistical reality. Ask yourself, can one isolated shape actually guarantee a market reversal? Like, can you spot a shooting star, bet against the market, and confidently expect to win? Well, to answer that, we have to look at rigorous academic findings from the FHSU Scholars Repository and Innovation Management Studies.
The contrast between the myth and the reality is pretty stark. The visual promise makes it feel like a nearly guaranteed reversal signal, but the statistical reality? Researchers tested these isolated single-candle patterns on the S&P 500 over long periods, and the result was shocking. They frequently performed no better than a randomly chosen candle. I'm going to repeat that. Trading a shooting star purely in isolation was basically a coin toss. It completely failed to consistently outsmart the market.
Let's dig into why that is in Section 4, Volatility and Behavioral Traps. So why do these patterns fail? Well, it all comes down to market regimes. The numbers from 2019 to late 2020 brilliantly illustrate the collapse of visual patterns under intense pressure. In a stable market, patterns like the hammer or bullish engulfing had a decent confirmation rate, around 67 to 70%. But look at what happens during the extreme volatility of the COVID-19 crisis. The predictive power plummets into the mid-40s.
They literally become worse than a coin flip when the market goes crazy.
Behavioral finance tells us a hard truth. Humans are often our own worst enemies. Traders suffer from overconfidence in these visual signals and just trust them blindly. Then stress triggers loss aversion, making people exit trades way too early. You've also got the disposition effect, where investors irrationally hold on to losing positions hoping for a magical bounce. And of course, herding behavior. In high volatility, people panic. Logic flies right out the window, and those pretty candlestick shapes get completely trampled by market noise.
All right, Section 5, the power of confirmation.
But don't worry, hope is not lost. The main takeaway from the research isn't that candlesticks are totally useless. It's that relying on them alone is super dangerous. The data reveals a massive turnaround when we combine them with hard mathematics. When researchers analyzed strategies using single isolated candlestick signals, the average return was negative 0.28%, basically a guaranteed way to slowly bleed your account dry. But when they combine those exact same patterns with technical indicators, the return flipped to a positive 1.50%. And even better, the standard deviation, which measures your risk and volatility, actually went down. So we're talking more profit, less risk.
This is where integrating tools like an exponential moving average, or EMA, and the relative strength index, the RSI, completely changes the game. By overlapping these mathematical tools, you effectively filter out the market noise and avoid those false behavioral traps. The RSI literally tells you if the market is statistically overbought, which confirms the visual story the shooting star is trying to tell you. If the math and the shape don't agree, you don't trade. It really is that simple.
Let's bring it all together in Section 6, Trading Safely and Managing Risk.
If you're going to use a pattern like the shooting star, you've got to follow a disciplined step-by-step procedure. Theory has to become practical application here. Step 1, spot the pattern, but make sure it's at a key established resistance zone. Step 2, have some patience. Wait for the very next candle to close. Rushing into a trade immediately after a shooting star invites a fake bull trap. Let the market prove it's actually reversing. And Step 3, confirm that downward momentum mathematically with an indicator like the RSI or MACD. Finally, we have to talk about defensive strategies because this is what actually keeps you alive in the market. Sourced from a comprehensive study on the Indian stock market, here are your essential risk management rules. Number 1, absolutely never trade a single candlestick in isolation. Number 2, employ strict stop-loss rules, like a hard 5% cutoff to stop the bleeding if you get it wrong. And lastly, if the price breaks above the very top wick of that shooting star, exit the trade immediately. The signal failed, the bulls are back in control, and recognizing that failure early is absolutely crucial to your financial survival.
I want to leave you with one final provocative thought today. Are you letting market psychology and impulsive visual biases control your trades, or are you stepping back and using structured data and technical confirmation to control your own psychology? In the completely unpredictable chaos of the financial markets, pairing your human intuition with cold, hard statistics might just be the only true way forward. Thanks for joining me on this explainer, and keep learning.